Ladies and gentlemen, welcome to Creating Tailwinds Podcast by FlightPath Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go.
Greetings, John. Welcome again. How you doing today?
I'm doing great, Jared. How are you?
Fantastic. Hey, I know we're a day after St. Patty's Day, but happy St. Patty's Day to you.
Oh, belated, yes. Happy St. Patty's Day.
Right?
Gosh.
We were talking yesterday about your humble roots showing up in Chicago, and I couldn't help but think about a Green River and what a cool celebration they do up there.
Yeah, that was something I always steered clear of because it was absolute chaos. Downtown Chicago, they dyed the river green, and it was a party for everyone. Antoinette used to go do that. But I watched it on television. I never went down there.
I heard someone today, I was talking about that topic with them, and they said that there's a Green River soda that is absolutely amazing. I don't even know if I would dare to try it.
I don't know about it. I know they dye everything green. There's the McFlurries in Chicagoland. I know that during that time they're probably still doing it. There's the Irish beer, which they dye beer green, and corned beef and cabbage.
That sounds fantastic.
Every shade of green.
Oh. Well, we're moving on from part 3 and on to part 4 of Nelson Nash's book, Becoming Your Own Banker. Part 4 deals with equipment financing. As we set this up and kind of get rolling into this, I think it's important to note that with some of these illustrations and some of the numbers that show up, we can get into the weeds really fast here, and I think it's important to note our goal is not to do that. Our goal is maybe to highlight a couple of points that show up. Is that a good way to describe it?
Yeah, I mean, the big takeaway on this chapter, Jared, on equipment financing, it's a chapter that everybody kind of gets bogged down in. Please don't, because you don't need to.
Sure.
This is entirely about two components inside of a dividend-paying whole life insurance contract that you are using for your banking system. One of them is interest only. That is the guaranteed portion of a contract. And the other one is the growth from dividends. And the dividends are what is available to all the policyholders once all the bills are paid and everything is, the mortality costs are covered, everything. What's left over is the dividend. And there's multiple ways, as you know, you can take that dividend. And the IBC method is to take it as additional fully paid up whole life insurance that comes with death benefit, and it also comes with cash value. Right. And so it's the capitalization of those two components together that make this so powerful. So
said.
Yeah, no. So like when you're going and running a piece of equipment, we ran into that gal at Think Tank. You remember?
It's Miss Susan.
Susan, yeah.
Yep.
And she was up to, 10 tractors, I think she said. She's up in Maryland.
Yep. Sure.
And what a great application for this, because when you buy something and finance something through a bank or other finance company, you don't participate at all in that money that moves out of your hands. It's theirs, and they utilize it for their benefit, not for yours. So when you keep it inside your own ecosystem, your own financial ecosystem, you benefit from that. So the whole idea that Nelson is trying to show here, and you might touch on a couple of points that you made previously, Jared, but when you capitalize this thing over a given period of years, I think in this example, he uses $60,000 a year for a period of time, and you do that with just one piece of equipment. You can do that with multiple pieces of equipment, stacking it year after year after year, and it is the totality of that financing experience where you're putting all that capital back into your system.
Sure.
And it's a little bit difficult to discuss the spreadsheet over a podcast, but anybody who wants to know about this, you and I could walk them through it, and it's very apparent from the spreadsheet how beneficial this is to businesses that need to finance equipment.
That's fair. That's well said. And I think one of the other takeaways is Nelson isolates some of the factors to prove his point in these illustrations. Another takeaway from some of these illustrations is that these aren't necessarily the way you set up an IBC policy. But what he's doing is highlighting a certain spot so that you can see both the power of this system and then how to put it in use. I guess I would just say that's the summary of what some of these illustrations are showing.
Right, right. No,
Yep.
it's a great point. And we talked about the two businesses that Nelson always said you should be in. You remember those?
That's right. He said you should be an amazing of whatever job you're in and a banker,
And which is the most important?
the finance.
Yeah, you bet.
That's right.
You bet it is. So, and as people build these things, and we're kind of glossing over a lot of the particulars, of course, Jared, but
Sure.
for those that have done this and have experienced it, and I've done these myself, it's just so vital to understand that there's a couple parts of this. You must set up a loan repayment plan that equals or exceeds what you would have paid to a regular commercial finance company. And it's that linkage that is so powerful. And if you can learn that discipline, you're going to do exceptionally well with this. Because why? You put money into an account. Say you borrow $60,000 out, and you set up an amortization schedule for yourself that you meet, and say your interest rate is, for the sake of argument, 8%. Double it. Why not? 16%. What does that do for you? Well, first of all, it accelerates the repayment back to who? The insurance company's general funds. Remember, our funds are never touched inside of our contract with the insurance company, although they hold them. So by paying a higher rate than you would have otherwise paid commercially, you're
Yep.
being an honest banker. You're treating yourself with and your money with the utmost respect. Because once that obligation is fulfilled, where's the rest of the money going? It's flowing to your paid up additions. It's flowing to your account,
That's right.
your policy.
Yep.
And so the sooner you capitalize these things in a given year, the more powerful they're going to become. Why? Because the dividend that's paid is predicated on the cash value. And the cash value, the sooner you get that money in there, the better it is to start working for you.
That's right.
And once it's in place, it's in place. Even if you're using the general funds of the life insurance company, so long as it's a non-recourse company like the ones we use, you're going to benefit from that. And
Sure.
that's a
Yep.
lot of money over time.
Well, playing honest banker sounds a lot like the story of the grocery store story about
Yeah.
how you have to make sure that as you stock the shelves, that when you need those peas for personal use, you go out the front door and pay the bill just like every other customer would and not steal the peas and walk out the back door and be a thief. And I think that's the other way to kind of bring back the story that you're saying, which is if you're going to loan that $60,000 and you're going to set up whatever your repayment schedule is, set it up like you would have gone to the bank.
Yeah.
Do a 4-year note, 8% interest. Well, then run that same exact calculator and do a 4-year note at 16% interest and see what the payment is and make that your monthly payment to pay back that 60 grand. Now,
Right.
the 8% that the insurance company is charging you, that's going into the cost of borrowing their funds. That extra 8% that you're talking about is going back into your policy so that you're building that cash value right back up again to continue to be used, to continue to be borrowed against, and to continue to make money for you. So it's a compounding effect. It's not just this, well, why would I pay the bank 16%? No, 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 no. Hold on. You're the banker now. You have to start thinking like a banker. You have to be an honest banker. If you're going to borrow your own money, borrow from the insurance ledger, you need to be able to have a plan to pay that back. Make sure that there's a plan. If not, you're stealing the peas. And Nelson would say, you're not going to be a banker for very long if you're stealing the peas.
No, sir, you won't be. And tying into what you just said, even though you're paying back the general funds of the life insurance company,
Yes.
you're benefiting from that directly because why? You're a part owner of that if it's a mutual company, which is who we use.
That's right.
So you're going to benefit. That's how the cash flows and swings back to you through dividend income.
I was going to dive into the first illustration that they show on the page 54 in the book. Really, what they've done here in Nelson's layout is the owner of this policy, which just so happens to be a 30-year-old male, has set it up for $40,000 premium over the course of 4 years. So
Right.
over the course of 4 years, they've put in $160,000. But this is the the startup cost, so to speak, of getting his business going. His plan is that he wants to have this set up so that he can borrow some funds from this whole life policy. He's borrowing against the cash value of his policy, and then he's going to be able to use those funds to finance his equipment that's running his business. Am I saying
Right.
that right? Is that the proper understanding? Is kind of a general outlay for this?
Yes, you are. And for those that are not familiar with these illustrations, and take them with a grain of salt because they kind of do get confusing for a lot of
It
people.
can, yeah.
But if you look at this, Jared, I mean, so this guy is paying into this thing in this first illustration for 4 years is 40 grand. What I always draw people's attention to is look at that net cash value year end. It is growing year over year over year, and they've stopped paying on this thing.
That's right.
So it becomes it really does become more and more efficient with time. And now you compare that to something everyone can relate to. Take an auto loan. You take a $40,000 note out for 60 months. The new auto loans are, I checked this, they're about 6.61% is the national average.
Sure.
Used cars are about 11.74%.
Wow.
So a new car financed over a 60-month period is going to give you about a $784 a month payment schedule,
Okay.
right?
Yep.
If you dig into those numbers and you look at the principal versus the interest, you're on that car, 72% of those payments are going first year just to interest. And then over the duration of the loan, it's about 17.7%, not the 6.61. And if you drop further down, let's say it's a used car, the numbers even get more gross.
That's right. This
It's
kind of sounds
40
like a previous discussion of it's not necessarily the interest rate, but the interest volume.
exactly. Used cars, yeah, right? 44% interest. And then over the totality of the loan, it's still a third of all the payments go toward interest
Mm.
on a used car. So what's happening is people are they're getting pushed now. They're not able to afford what they used to afford now. So the finance companies are kicking the can down the road and they're giving them additional time to pay it back. So the average car loan is now up to 68 months, 5 years, 8 months. And
Wow.
now 20% of all the cars now sold have 84-month loans, 7 years. You
Wow.
are upside down on that capitalization when you're going out that far. You don't have to do this. You could do this inside of an IBC contract at 5-6%, and the money stays inside your ecosystem, your financial ecosystem.
That's right.
Tremendous. So anyway, just
So
wanted to point that out.
So it doesn't matter whether or not you're using this for your personal environment or a business. It does apply
Exactly.
to both, right? Like, in this example, they're using the equipment financing. They're talking about buying a tractor for a farm every four
Right.
years.
What if it's a
But
Maserati?
yeah,
You're buying a
exactly.
$160,000 very expensive car. Same principle applies.
It's all the same. It's just a matter of how many zeros are behind it, right? It's all the same theory. As long as you're capitalizing first, then using the system, now you're keeping it in your ecosystem. As you've said, you're gaining money off of the money that's sitting in your account, in your whole life policy, and you have access to the use of the capital. I heard a really interesting description of this, and it was at the recent think tank. They had said, these policies that you set up, these whole life policies, have an internal rate of return, which is obviously the money that's either paid in dividend or interest that shows up year over year. And then there's the external rate of return, which is you putting your funds to use, whether it's a real estate investment or stocks, pick wherever you want to, maybe personal lending. A lot of folks do that. So you've got the internal, you've got the external, and then you've got the eternal rate of return.
Right.
I was just kind of caught a guard by that because the eternal rate of return, as you're turning over these, large lump sums of a lifetime's worth of savings, and you're turning them over to the next generation completely tax free. So this internal, external, and eternal rate of returns, how do you put a number to that? I mean, that completely blew me away, and I was so enjoyed hearing that description that I told him that I asked if it was patented, if I could steal it. He's like, nope, that's yours. Use it all you want.
Yeah, there are so many takeaways from doing this, and it's going to strike everyone else or everyone differently.
Sure.
Everyone's going to have their own priorities, and many, and I think I'm I share your sentiments in that regard. The eternal rate of return is very huge. So, you know, one of the things in my research, Jared, I looked at the uh, bank rate, for instance, and the best lender, since we're talking about capital equipment
Mhm.
for startups, was called On Deck. You can go look at it out there.
So this would be
This was
like a small business just starting up, just getting their feet off the ground.
exactly right.
Uh-huh.
They loan $6,000 to $100,000, 12 to 24-month period. You know
Okay.
what the starting rate was? The interest rate they're charging
I don't
people?
know, shoot high, I'd say 20, 25%.
35.9%. That is insanity. That means a doubling of cost every essentially 2 years, rule of 72s, right? And
Wow.
so not only do you do that, giving it all away, people are paying out this kinds of money, even if they've got a great idea and a great business. Cash flow is everything, and you're giving somebody else all that cash flow. You got to look at the current risk-free cost of capital, the current risk-free cost of money right now using the 10-year Treasury yield, right?
Yep.
This is as of yesterday, 317.25 was 4.31%. So if you look at that and you layer that on top of the money that you're spending, in 1 year, this was, I believe, on the car on 40,000, it was like $1,724 of lost opportunity cost. 5 years, $9,395. 10 year, 21,000. And then if say this guy is 30 years old or gal, and they go out toward retirement at 65, 35 years, that's $135,173 of lost opportunity cost. And
And
that's
that's just letting it
one,
sit in a treasury note. Like that's not any
yes.
risky note, right? That's just your standard, treasury bill.
Of course, and certainly those numbers are going to be higher or lower than that. That's just
Sure,
taking a
sure. They'll move and ebb and flow. I get that.
snapshot in time, you know.
Sure.
But the point is that is all that money finds its way back into your contract, and that is what's so powerful. And that's the part of it that we're trying to make people see. Get these things going, get them funded. Don't be afraid to capitalize them, and they will bear great fruit for you. And the longer your time horizon, the better.
Sure.
But it doesn't. I'm 61, Jared. Is it a bad idea for me to start one right now?
No, not at all.
Why?
My answer to that would be one, you still have plenty of good life in front of you that you have a very easily insured interest, right? Folks are living to 80, 90 years old nowadays. The insurance company is not going to charge you out the wazoo for your rate to set up a whole life policy. Now, you may not be able to give a whole lot over the next 4 to 14 years, but you have all the opportunity in the world to set up the most important part, which is the cash value of your whole life policy that truly unlocks what we're talking about. So there is a aspect that is the life insurance piece because that is the vehicle that is the most user friendly, and it's the setup that Nelson recommends in terms of how you set up these IBC policies. But you've got a chassis that is a whole life policy and the insurance piece with the goal to access the cash value that now unlocks your ability to gain a percentage on that funds while you use it.
Okay, so take it a step further. I'm planning
Sure.
a year, 2, 5, 10 years down the road.
Yep.
What about the legacy component? What if I want to give, somebody down the street because they've been wonderful to my family and I've got the money and I'm gonna leave them $1 million. What is the most effective way, or at least one of them,
Yep.
to give them $1 million?
For
How
sure.
about your
For
family?
life insurance.
You bet. So
Pass it along tax free. Uncle Sam doesn't show up to
exactly.
take their portion.
Exactly. Whether people that are doing this are looking 3 and 4 generations downstream, because what a beautiful thing to build a capital credit facility that is building tax free over time and transfers to your loved ones, your wife, your kids, your business partner, however the structure is. That money goes to them tax free if structured correctly.
That's right.
And that first dollar that you put in 30 years ago, and say I graduate 10 years into this thing, 30, 40, 50 years downstream, somebody else's benefit that I care about from that first dollar that I put to work.
Yep.
So,
The
it's
other The other part that you would add, if you came to me and asked that same question, I would want to get to know you a little bit more as well to know what's the age of your wife? Out to what level is she covered? Do you have any kids? Do you have any grandkids? All of these are also insurable interests as well, where you could start a policy in their name that you are the owner and you are the controller of how all things flow through that policy and through that account. So it's not always your life that has to be protected. There are still ways around your ability to set up the infinite banking style policy that would then allow you access to becoming your own banker to truly build your warehouse of wealth.
Yeah. And since we're on the capitalization of equipment,
Yep.
there's an exhibit in here that you're familiar with, that description of vehicle collateral. Because when these financing companies give you the money,
Yep.
they make you jump through all kinds of hoops. And say they give you the
Sure.
money, if you look into that thing, this is on 56 of Nelson's book.
Yep.
He talks about that the seller shall have the right to reject for reasonable cause any insurer offered by the buyer. So they can even pick who you're going to insure your equipment with. And
Sure.
then if you go to the bottom of this darn thing, the default coverage in the event of a late payment, if any installment is not paid within 10 days after it's due, buyer agrees to pay late charges 5%. It goes on to say, if allowed, or in lieu of, if allowed by law in the state in which the contract is entered into, interest at the highest rate allowed, whichever is greater. So here you are.
Yep.
These contracts are designed to maximize the interest and the expense that you have to turn over to the finance companies, and you do not participate in that. If that was inside of a life insurance contract and you were late, it is a non-event. You just carry it at interest.
That's right.
It's
So in
simple,
this
simple,
instance,
simple.
if you don't pay, they are going to come and not only charge you extra money in fees and the highest interest rate they can find, they have the opportunity to repossess that vehicle, whichever the vehicle is, as collateral for that loan, as
Yes.
opposed to if you use a policy loan from the cash value of your life insurance contract, what happens if you don't make that payment?
Huh. Yeah. The contrast is so compelling. I just want to scream from the rafters to people, say,
Right.
take a look at this.
That's
You're
right.
not going to believe what a much better deal this is.
Sure. They
But
don't
people,
they there's nothing to repossess. They can't come back and take it. Now they are still able to collect the interest that shows up year over year,
sure.
and you have multiple different ways to cover that back. But this goes right back to the initial statement we were talking about being an honest banker. You don't just build these cash values up to then steal from yourself. You go into it with the assumption of, if I'm going to use these cash values is, I guess, the best way to describe it, as collateral to borrow from the general ledger of the insurance company
Yeah.
and then deploy that and put it into use, I
Yeah.
better have a darn good plan on how I'm going to get that back in. Now, there's
Right.
some other ways when you get into retirement and you get into some different ideas that, there's some other options. You're not locked into that. But for the portion that it serves through most of your adult life, when you're recapturing this debt, or I'm sorry, when you're recapturing the interest, your own interest, you're going to have a plan to pay it back. So there's the honest banker portion of this, and this is why, I know I speak for you here, John, by saying, we don't just set you up and say good luck, send you on your way. We serve as not only a resource for you throughout the year, but we're going to do an annual review with you. Like, we don't just, like I said, send you on your way and wish you the best and give you a pat on the butt. We're going to say, how's things going? How are you
Right.
deploying this capital? Have you seen that this is how it's performing? These are all different ways that I know you treat it this way, as I've been a client of yours, and I try to do the same as I work with the next generation as well.
Yeah. It's a process. It's not a transaction. Anybody doing this as a transaction is doing it incorrectly. And Nelson would tell you that. He said you shouldn't be in this business if that
That's right.
for this
And he would
purpose.
say you've got to think long term. This is
Exactly
not a
right.
get rich quick scheme. This is not a quick turnaround. Show me what you can do for me with my best rate of return. This is a long term generational plan of
Yeah.
which you're in the driver's seat.
And the recommendations inside here that really flowed from Nelson. These are some of the same techniques that I use. I self-insure wherever I can, and what better way to do that than within an IBC contract? You have one of these trucks in this case. maybe it's the down payment portion. I don't know. Or you can have on a vehicle, for instance, wherever I can, I'm going to use two, three, $5,000 of a self-insured money
Sure.
that the insurance company is not on the hook for. Homeowners insurance, you can get a $5,000 deductible. Why not? If you can't capitalize $5,000 on your own place, then maybe you're in the wrong place for where you're at in life. I don't
Right.
know,
Sure.
but you can certainly do this, and you will over time. I have saved so much money in deductible costs by carrying high deductibles, and you can do this same thing within these contracts, Jared. Right?
Yeah, so
So,
what you're to translate what you're saying is even though you do actually have a home or an auto insurance product, you have a higher deductible than normal, knowing that God forbid something did happen to that home or that vehicle, not only are you able to cover the higher deductible through the policy loan or through your own infinite banking policy, but you also have additional protection to cover the cost of those items in your infinite banking contracts. Am I saying that right?
you are saying that right.
Yep.
Absolutely right.
But that doesn't show up in year one. That doesn't show up in,
No.
these like we said, this is the long-term thinking. The same thing that we were talking about. This is why I love the grocery store story so much. The other thing that relates back to that, it's not just don't steal the peas, but it's, the amount of turnover just to make profit on one can of peas. He has to turn that thing over or sell 16 to 18 cans of peas and then
Right.
restock the shelves. So he has to restock it 16 to 18 times just to turn profit on that one can of peas. So
Yeah.
when you're looking at these whole life products that may be 5, 7, 10, 14 years before you've, truly reached or unlocked the potential of what you've put into it, these are all the minor startup costs of what you've got
Oh yeah.
access
And
to from a generational
Nelson.
perspective.
Yeah. I mean, Nelson talks about this. People think that these insurance companies are manufacturing cash. They're not. It takes, he says, about 13 years for them to capitalize every contract.
Right.
One policy takes them about 13 years. So they make money on a massive book of business, but at a relatively small margin.
Sure.
And it's that margin that makes all the difference in the world. And guess what? You and I participate in that
That's
margin
right.
and in those dividends, which
Well,
makes this whole thing beautiful.
that's why they don't just insure one person, right? That would be silly to have all that risk and then God forbid something happens to that person, they're out. When
Right.
you start these whole life policies, the most risky day for the life insurance company is the day that you sign that contract, and then every day that you move towards the day that you graduate, you the risk gets just a little bit lower because they've had all that time to invest and build the capital that you've capitalized to then be able to pay out that death benefit someday when you graduate.
That's right. That's
Yeah.
right. The one concept, and it's not even a concept, and we talked about this before you go to what 63 in the book, I believe it is. Nelson talks about the outset that this is an exercise in what? Imagination, reason, logic, and prophecy.
That's exactly right.
You
But
know,
what does
and
he compare it to in terms of how all that becomes through your behavior?
your behavior. Everything is about our behavior ultimately, because without our inertia, without our action, nothing gets done. And that's true in all aspects of wonderful things in life. You've got to set your sights on it, identify what the target is, and go for it and get it done and execute. So yeah, he says your behavior in managing the system is the most important factor in the entire equation. And I think people who read this book that's on page 63 should highlight that and write it down and put it on the front of the book. And every time they look at the book, they should read that, because without action, ideas are nothing but ideas.
That's right.
Without action, success is nothing but dreaming about success. Without action, your financial goals are nothing but pie in the sky dreams. But you can realize this stuff. This is doable. And is it hard, Jared? Is this difficult?
I don't think it is, but that's just because I dove in and kind of figured out some of the ways for it to make sense to me. I
Yeah.
didn't I didn't want someone else to tell me about it. I wanted to learn about it on my own. And once that key clicks or that lock opens, it's like doves are released at the end of a wedding. It's like it's like, how did anybody not see this before? So to answer your question, no, this is not difficult. This is so far from difficult.
Right.
Yet there's a lot of financial noise out there, and there's a lot of, you know, decades of undoing the generational banks that are out there that are making a lot of money off of you and I beforehand. There's a lot of other folks that are like that out there,
You bet.
and it's once you see it, it's a caught not taught type of a situation. You really do have to allow for it to unlock, but you've got to rethink your thinking, and you've got to approach it from a different way. Because if not, you just follow the masses that have done all the other things for so long.
Right. Without going into great depth into these charts, Jared, I think we're toward the end of part 4.
Yes.
And if someone wants to learn more about this, how do they get a hold of us?
Well, they can find us on the website. We've got a link on the flightpathfinancial.com website where they can contact us and book either a 30-minute free consultation with you, John, or with me, Jared. And we would love to take time to sit down with you and talk more about either the book or maybe how we can apply this to your life or your situation.
Yeah, I think that's wonderful. And ladies and gentlemen, those of you that are listening, we greatly appreciate you spending some time with us. We'd love to help you. We'd love to share more about infinite banking and the power of infinite banking with you. And please pass along this podcast, our information to your friends, family, your coworkers. There's so much that can be done with this system if you only learn it and employ it. So I'll sign off there, Jared. Thank you so much. Have you got anything in closing?
Spot on. Nothing else to add. It was always a pleasure to be with you. Look forward to the next time.
All right. Wonderful. Thank you,
Thanks,
Jared.
John. Have a good day.
Have a great day. We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.